$1,000. That is the number most people think of when they imagine finally starting to invest. Not $1 million. Not $100,000. Just $1,000 sitting somewhere waiting to do something useful. And here is what most people do with that $1,000 when they finally have it. Nothing. They leave it in a checking account earning 0.01% interest. They tell themselves they will invest it when they know more. They wait for the perfect moment. They watch it sit there month after month losing value to inflation, while they research and delay and overthink, and the years pass. And the $1,000 is still just sitting there. Doing nothing. Going nowhere. I want to tell you something about $1,000 that most people do not realize until it is too late. $1,000 invested at 25 years old becomes roughly $21,000 by the time you are 65 at the market's historical average return. The same $1,000 invested at 35 becomes roughly $10,000 by 65. The same $1,000 invested at 45 becomes roughly $4,700 by 65. You did not earn more money. You did not get smarter. You did not find a better investment. You just started earlier. Time is the most powerful force in investing. And every single day you wait costs you money. Real money. Money you will never get back. By the end of this video you are going to know exactly what to do with your first $1,000. Not someday. This week. Step by step. No jargon. No confusing terms. Just a real plan that any beginner can follow starting today. Stay with me. Because this is the video I wish someone had shown me at the very beginning. Let me tell you the real reason most Americans never invest. It is not because they do not have money. Plenty of people with very little money have built real wealth through investing. It is not because they are not smart enough. Investing at the basic level is genuinely not complicated. The real reason most people never start is because the financial industry has made investing seem far more complicated and intimidating than it actually needs to be. Walk into any financial conversation, and within 5 minutes someone is throwing terms at you. Mutual funds. ETFs. Expense ratios. Asset allocation. Rebalancing. Diversification. Dollar cost averaging. And the average person hears all of that and concludes one thing. I am not ready yet. I need to learn more first. So they go learn more. And they find more terms. More strategies. More opinions. More disagreements between experts. More complexity. And they never start. Here is the truth that the financial industry does not benefit from you knowing. You do not need to understand everything about investing to start investing. You need to understand a few basic concepts. And then you need to start, because starting with imperfect knowledge beats waiting for perfect knowledge indefinitely. The best investment you will ever make is the one you actually make. Not the one you plan to make someday. Before we talk about what to do with your $1,000, let us make sure we are clear on what investing actually means. Investing is putting your money to work so that it grows over time without you actively doing anything. That is it. That is the whole concept. When you leave your money in a checking account, it sits there doing nothing. The bank might pay you 0.01% interest, which on $1,000 is 10 cents a year. When you invest your money, you are buying a tiny ownership stake in real businesses, and those businesses generate revenue, earn profits, grow over time, and your ownership stake grows in value along with them. You do not have to manage those businesses. You do not have to understand their quarterly earnings reports. You simply own a small piece of them and benefit as they grow. This is what the stock market actually is. Not a casino. Not a gambling platform. Not something only rich people or finance professionals use. It is a system that allows ordinary people to own small pieces of the largest and most successful businesses in the world and benefit as those businesses create value over time. The reason wealthy people stay wealthy is not primarily because they earn more. It is because their money is working for them while they sleep, while they eat, while they are on vacation. Their money is invested and growing constantly. Your first $1,000 invested is the beginning of making your money work for you instead of just sitting and waiting. Before you put a single dollar into investments, 3 things need to be in place. The first thing is a basic emergency fund. If you have been watching this channel for a while, you have heard me say this before, and I am going to say it again because it matters that much. Do not invest your emergency fund. Do not invest money you might need in the next 6 to 12 months. Do not invest money that has another job to do. Investing works over long periods of time. The stock market goes up and down constantly in the short term. If you invest money and then have an emergency 6 months later and need to pull it out, you might pull it out at exactly the wrong moment and lose money. Your emergency fund of 3 to 6 months of expenses stays in a high-yield savings account. Separate. Untouched. That money is not for investing. It is for protection. The second thing is that your high-interest debt should be gone or under control. If you have credit card debt at 24% interest, paying that off is a guaranteed 24% return. Nothing in the stock market gives you that consistently. Pay off high-interest debt before investing aggressively. Low-interest debt like student loans below 6% or older mortgages with lower rates is a different conversation. You can invest alongside those. But high-interest consumer debt should go first. The third thing is a clear commitment to leaving your investment alone. The single biggest mistake beginner investors make is panic selling when the market drops. They see their $1,000 become $800 during a market correction and they pull it out to stop the loss. Then the market recovers and they miss the recovery entirely. Investing only works if you leave it alone. If you are not prepared to watch your investment drop by 20% or 30% temporarily and do nothing, you are not ready to invest yet. Get mentally ready first. Because market drops are not a sign something is wrong. They are a normal part of the process. Okay. Emergency fund is there. High interest debt is handled. You are mentally prepared to leave the money alone. Where does the $1,000 actually go? 2 places. In this order. First priority. A Roth IRA. A Roth IRA is a retirement account that gives you one of the most powerful benefits available to ordinary investors. You invest money that has already been taxed. It grows completely tax-free. And when you withdraw it in retirement, you pay 0 taxes on any of the growth. 0 taxes on potentially decades of compound growth. If your $1,000 grows to $21,000 by the time you retire, you pay no tax on that $20,000 of growth. None. Compare that to paying ordinary income tax rates on that growth in a regular account, and you are talking about thousands of dollars of difference. In 2026 you can contribute up to $7,000 per year to a Roth IRA if you are under 50. Your first $1,000 should go here. You can open a Roth IRA at Fidelity, Vanguard, or Charles Schwab. All 3 are reputable. All 3 have no account minimums for basic index fund investing. All 3 are free to open. Second priority. If you have already maxed your Roth IRA contribution or are not eligible due to income limits, a regular brokerage account works fine. You will pay taxes on gains, but you still benefit from compound growth over time. You have opened your account. Your $1,000 is sitting there. Now what do you actually buy? This is where most beginners overthink everything. Individual stocks. Crypto. Sector funds. Hot tips from social media. I am going to make this extremely simple for you. Buy a total market index fund or an S&P 500 index fund. That is it. Nothing else required for a beginner. Here is what that means in plain English. An index fund is a single investment that automatically owns a tiny piece of hundreds or thousands of different companies at once. When you buy an S&P 500 index fund, you own a small piece of the 500 largest companies in America. Apple, Microsoft, Amazon, Johnson & Johnson, Visa, all of them. With one purchase. You are not betting on one company succeeding. You are betting that American business as a whole continues to grow over time. Which historically it has. Consistently. Over every 20-year period in modern market history. The historical average annual return of the S&P 500 is roughly 10% per year before inflation. Over long periods that is extraordinarily powerful. Some specific funds to consider. At Fidelity, FCROX is a total market index fund with zero expense ratio. At Vanguard, VTI is a total market ETF with an extremely low expense ratio. At Schwab, SWTSX is a total market index fund with a very low expense ratio. Do not overthink which one. Pick one platform. Open a Roth IRA. Buy the total market or S&P 500 index fund they offer. Done. The perfect index fund you never buy is worth nothing. A good index fund you buy today and hold for 30 years is worth potentially life-changing amounts. Let me show you the actual numbers so this stops being abstract. You invest $1,000 today. You never add another dollar. At 10% average annual return. In 10 years your $1,000 becomes approximately $2,594. In 20 years your $1,000 becomes approximately $6,727. In 30 years your $1,000 becomes approximately $17,449. In 40 years your $1,000 becomes approximately $45,259. You invested $1,000 one time. You did nothing else. 40 years later it is worth $45,000. This is compound interest. Your returns earn returns, which earn more returns. The growth accelerates over time, but here is where it gets really interesting. Now instead of investing once and stopping, imagine you invest $100 every single month starting with that first $1,000. In 10 years you have approximately $21,000. In 20 years you have approximately $76,000. In 30 years you have approximately $226,000. In 40 years you have approximately $637,000. You invested $100 a month for 40 years. That is $48,000 total of your own money. The rest, over $589,000, came from compound growth. This is available to anyone. Not just wealthy people. Not just finance professionals. Anyone with $100 a month and 40 years of patience. The people who retire with real money are not usually people who made more. They are people who started earlier and stayed consistent. Now that you understand the basics, let me tell you the 5 most common mistakes beginners make that destroy their investment returns. The first mistake is trying to time the market. Waiting for the market to drop before investing. Waiting for the perfect entry point. Waiting for things to settle down. The research on this is extremely clear. Time in the market beats timing the market. Every study done on this reaches the same conclusion. The investors who try to time the market consistently underperform the investors who simply invest regularly and leave it alone. The second mistake is panic selling during downturns. The market will drop. Sometimes significantly. In 2020 the market dropped 34% in about a month. People who panic sold locked in those losses. People who held on had fully recovered within months and went on to significant new highs. Your job as an investor during a market drop is to do nothing. Possibly to buy more if you can. But mostly to do nothing. The third mistake is checking your investments too often. If you check your investments daily, you will drive yourself crazy. Market fluctuations are normal and constant. A $1,000 investment might be worth $980 on Tuesday and $1,040 on Thursday. Watching this daily creates anxiety that leads to bad decisions. Check your investments quarterly at most. Set it and forget it. The fourth mistake is chasing performance. The investment that performed best last year is almost never the investment that performs best next year. Chasing last year's winners is a reliable way to consistently buy high and miss the actual returns. Stick with the total market index fund. It captures the market's overall performance without trying to predict which sector or company will outperform next. The fifth mistake is waiting until you have more money to start. This is the most expensive mistake of all. Every month you wait costs you compound growth you can never recover. Start with whatever you have. Even $50. Even $25. The amount matters far less than starting. Here is exactly what to do. Step by step. Step 1. Make sure you have a basic emergency fund of at least $500 to $1,000 in a high-yield savings account. If you do not, build that first. Step 2. Make sure your high-interest debt above 10% is paid off, or at least have a clear, aggressive plan to pay it off. If not, handle that before investing. Step 3. Go to Fidelity.com, Vanguard.com, or Schwab.com and open a Roth IRA. It takes about 15 minutes. You will need your social security number, your bank account information, and your basic personal details. Step 4. Fund your Roth IRA with your $1,000. You can do this via bank transfer directly from your checking account. Step 5. Inside your Roth IRA, purchase a total market index fund or S&P 500 index fund. At Fidelity, this might be F0X or FXAIX. At Vanguard, this might be VTI or VFIX. At Schwab, this might be SWTSX or SWPPX. Any of these work for a beginner. Step 6. Set up an automatic monthly contribution. Even $25. Even $50. Automate it so it happens on payday before you have a chance to spend it. This is how wealth actually gets built. Not through one big decision but through consistent small ones over a long period of time. Step 7. Do not touch it. Set a calendar reminder to check it once per quarter. Otherwise, leave it completely alone. You came into this video not knowing what to do with your first $1,000. You are leaving with a complete step-by-step plan. Emergency fund first. High interest debt handled. Open a Roth IRA. Buy a total market index fund. Set up automatic monthly contributions. Leave it alone for decades. That is the entire strategy. It is not complicated. It does not require a financial advisor. It does not require understanding every term in the finance world. It requires starting. The person who invests $1,000 this week and adds $100 a month consistently will look back in 30 years at a number that seems impossible from where they are standing right now. Not because they were special. Not because they got lucky. Because they started and they stayed consistent. Start this week. With whatever you have. And I want to know something from you. What has been stopping you from investing so far? Drop it in the comments. I read every single one. And if enough people share the same obstacle, that becomes our next dollar focus video. If you want to go deeper on exactly which index funds are the best for beginners and why, that video is coming next on this channel. Watch it the moment it drops. Because this video gave you the foundation and that one gives you the specifics.